Welcome to the deep dive. Today, we're really tackling the foundations, finance and economics.
Yeah, the essentials. We're aiming to give everyone listening a solid grip on how money, markets, well, how the whole economy actually ticks.
Exactly. Think of this as your shortcut, cutting through maybe some of the jargon.
hmm We've looked at quite a few sources to pull out the core ideas, those aha moments.
Without getting too bogged down, hopefully.
That's the plan. Make it clear, make it useful.
So our mission today is pretty straightforward. We'll start with what finance actually is, its purpose, then weave in those key economic concepts.
Things like supply and demand, definitely. Factors of production.
Right, and cash flow, always crucial. We'll touch on how economies get measured, GDP, and all that.
And principles behind economic choices. It's
Yeah.
really a launch pad into this whole world.
Okay, so let's launch. To kick us off then, what is finance really, in its simplest terms?
At its heart, finance is about money,
Hmm.
managing it, studying it, currency, assets, liabilities, all that stuff.
So it's the study of monetary resources.
Pretty much. It's closely linked to economics, of course. But economics is broader, right?
Mm.
Production, distribution, consumption of goods and services.
Whereas finance zooms in.
Yeah, it zooms right in on the money flow, how we value assets, how we allocate resources over time. That's a key function.
And things like capital markets help with that allocation.
Absolutely. Capital markets are where, funds get channeled, and firms make those big production and investment decisions. It's about connecting those who have funds with those who need them.
Okay. And it also involves like raising money, managing it.
Definitely. Managing funds. It's also about the relationships between, say, businesses looking for profit and the people supplying the cash, investors, lenders.
Right. So one source we saw kind of described it as applying economic principles to money decisions, especially when things are uncertain.
That's a great way to put it. Because uncertainty or risk is a huge part of finance. It's making decisions about money under uncertainty.
And practically speaking, it helps organizations, well, do things by managing debt and credit.
Exactly. It ensures they have the means to carry out whatever their objectives are. It's, like one source said, fundamentally about managing the flows of money.
The lifeblood, you could say.
Yeah, and it's not just one skill set. It's a profession that needs, a mix of training, economics, accounting.
Maybe even some psychology, understanding risk
Yeah.
appetite.
For sure, it's interdisciplinary. And it allows production and consumption to happen independently across time, across space. That's pretty powerful.
Okay, great definition. So finance relies on some bedrock economic ideas. Where should we start with those fundamental principles?
I think a good starting point is always trade-offs. It's fundamental. We can't have everything.
Because resources are scarce, right?
Exactly. So every decision means giving something up, choosing one thing over another. This happens everywhere: personal life, business, government.
And a classic trade-off mentioned is efficiency versus equity.
Yes, getting the most out of resources versus distributing the benefits fairly. The constant balancing act.
Which leads straight into opportunity cost.
Right. The real cost of something isn't just the price tag. It's what you sacrifice to get it.
The next best thing you could have done instead.
Precisely. Even your time has an opportunity cost. If you spend an evening watching TV.
You could have been doing something else, maybe earning money, maybe learning something.
Exactly. And economists generally assume people think rationally at the margin.
Okay, what does at the margin mean here?
It means thinking about small changes, incremental adjustments. Like, should I study one more hour? Should a company produce one more widget?
Comparing the little extra benefit versus the little extra cost.
That's the idea, making decisions based on those marginal changes.
Got it. And then incentives, people respond to them. Seems obvious, but it's powerful.
Hugely powerful.
Mm.
Bonuses, taxes. They change behavior. Positive incentives encourage things, negative ones discourage them. It's a core driver.
Okay. What about trade?
Yes. The idea that trade can make everyone better off, it's not always win-lose.
Because of specialization.
Exactly. If everyone focuses on what they do best and then trades, everyone can potentially gain. Think about countries trading goods.
So more efficiency, more variety overall.
Right. Now, how does this all get organized? Often through markets.
Market economies, where households and firms sort of interact.
Yes. Guided by self-interest. But Adam Smith's invisible hand prices basically tends to guide resources pretty efficiently. Usually.
Really? But not always perfectly. That's where government intervention might come in,
Correct. Sometimes markets fail. You get market failures, like externalities pollution's the classic
where
example.
the cost isn't fully borne by the polluter.
Right. Or maybe there isn't enough competition. So government might step in to enforce property rights, address those externalities, maybe promote equity or efficiency.
Okay. Shifting slightly, how does a country's overall wealth or living standard improve?
Largely through productivity. A country's standard of living depends heavily on its ability to produce goods and services efficiently.
Makes sense. More output per worker means higher average incomes.
Generally, yes. And related to the money side, inflation. What happens when there's too much money floating around?
Prices go up, right? That's inflation, printing too much money, chasing too few goods.
That's the basic mechanism, yeah. It erodes purchasing power.
And finally, this idea of a short-run trade-off between inflation and unemployment.
The Phillips curve, yes. The idea is that in the short term, policies aimed at reducing unemployment might lead to higher inflation and vice versa. It's a challenge for policymakers.
Okay, wow, that's a lot of foundational economic ground covered.
It really is the bedrock for understanding finance. And a crucial mechanism within that is supply and demand. We hear about it all the time.
Right. The two big forces in a market determining price and how much gets sold, assuming no government interference, like you said.
Exactly, a balancing act. Let's take demand first. What influences how much people want to buy?
Well, the price, obviously. Usually higher price means less demand.
The law of demand, yeah.
Right.
But also income, right? More income often means more demand for normal goods.
And the price of related goods. Like, if coffee gets expensive, maybe more people buy tea.
That's a substitute. Or cars and gas complements. If gas prices soar, demand for big SUVs might drop.
True. And just tastes, what people actually like, plus expectations about the future.
Yeah, if you think prices will rise next week, you might buy now. All that shapes the demand curve.
Okay, flip side. Supply. What makes producers willing to sell?
Again, price is key. Higher price, usually more incentive to supply, but also input costs.
Like labor, materials, energy. If those go up, supply might shrink.
It likely will, yes.
Yeah.
It costs more to produce. Technology is huge, too. Better tech can lower costs and boost supply.
Could be. And expectations again. If producers expect prices to fall, they might sell more now.
Could be. Or hold back if they expect prices to rise. So supply and demand are these curves. Where do they meet?
That's equilibrium, where quantity supplied equals quantity demanded.
And the price at that point is the equilibrium price, or the market clearing price. No surplus, no shortage.
But things change, right? What shifts these curves?
Absolutely. A change in any of those underlying factors, besides price income, tastes, technology, input costs, will shift the entire curve.
So if, say, incomes rise sharply, the demand curve shifts outwards.
To the right, yeah. Meaning people want more at every price. That usually pushes the equilibrium price and quantity up.
And if technology improves production,
Supply curve shifts right. More supplied at every price. That tends to lower the equilibrium price and raise the quantity.
our sources also mention elasticity, how responsive things are.
Exactly. It measures how much quantity demanded or supplied changes when price or income or something else changes.
So if a small price change causes a huge change in demand, it's elastic.
Very elastic, like
Yeah.
maybe luxury goods. If the price barely affects demand, like for essential medicine, it's inelastic. It's super important for pricing strategy.
Okay, great. Supply and demand covered. Now, what about the ingredients needed for production, the factors of production?
Right, the essential inputs. Traditionally, there are 4 key ones.
Let's list them. First is land.
Yep. And that means more than just dirt. It's all natural resources. Minerals, water, forests, the physical space itself.
Okay. Second.
Labor, the human effort involved. Physical, mental, all of it.
And sometimes we talk about human capital within labor.
Yeah, that's the skills, the knowledge, the experience workers have. Education and training build human capital, making labor more productive.
Got it. Third factor.
Capital. Now be careful here. In economics, this usually means physical capital.
Not money.
Not money itself, no. It's the tools, machinery, buildings, computers, stuff used to produce other goods and services.
Okay, crucial distinction.
Yeah.
And the fourth factor.
Entrepreneurship. This is the spark plug, maybe.
The initiative, the risk-taking.
Exactly. Organizing the other 3 factors, land, labor, capital, taking the risk to start a business, innovate, bring something new to the market.
And technology plays a role across all of these.
Oh, absolutely. Technological progress can make land more productive, labor more efficient, capital more powerful. It's a massive driver of growth.
And different industries rely on these factors differently, I assume.
For sure. Tech companies are heavy on human capital and physical capital, like servers. Yeah. Farming is more land intensive. It varies.
Okay, makes sense. So those are the inputs. Let's swing back to finance principles now. Cash flow sounds important.
It's vital. Simply put, it's the money moving into and out of a business, net balance over time,
And it's broken down.
usually into three types. Operating cash flow from the core business activities, investing cash flow buying or selling long-term assets like equipment, and financing cash flow dealing with debt, equity, paying dividends.
And generally, positive cash flow is good, more coming in than going out.
Especially from operations, yeah?
Hmm.
It shows the main business is healthy and generating cash to sustain itself and maybe grow. Analyzing the statement gives huge insights.
Okay. Another big one, risk and return.
The classic trade-off in finance. You want the chance for higher returns. You generally have to accept higher risk.
No free lunch.
Pretty much. Investors demand compensation for taking on uncertainty. This links directly to return on investment, or ROI.
Which is just measuring your profit against your initial cost.
Essentially, yes.
Yeah.
Net cash return divided by the investment cost, usually as a percentage, a basic measure of profitability.
All right. So we have principles for businesses. How do we measure the whole economy? We mentioned GDP earlier.
Gross domestic product. It's the big one. The total market value of all finished goods and services produced within a country's borders in a specific period.
Like a year or a quarter, a big scorecard for the economy's size and health.
That's a good way to think of it. And the change in GDP, the growth rate, tells you if the economy is expanding or contracting.
We hear about nominal versus real GDP. What's that difference again?
Nominal GDP uses current prices, so it can go up just because of inflation. Real GDP adjusts for inflation, so it shows the actual change in the volume of production. Much better for comparing over time.
And per capita GDP. Just GDP divided by population.
Yep. Gives you a rough idea of average economic output per person. Often used as a proxy for average living standards, though it doesn't show income distribution.
How is GDP calculated? I remember the expenditure approach.
That's the most common one taught. You add up all the spending. Consumption, C, by households. Government spending, G. Business investment, I. And net exports, NX, which is exports minus imports. C plus G plus I plus NX.
But there are other ways.
Yeah, the production or value-added approach, summing up the value added at each stage. And the income approach, summing up all incomes, earned wages, profits, rent, interest. They should all theoretically match up.
And there are similar measures like GNP and GNI.
Right. Gross national product and gross national income. They focus on income earned by a country's residents, regardless of where it's earned, unlike GDP, which is about production within the borders. Slight differences.
And why is that GDP growth rate figure watched so closely?
Because it signals the economy's momentum. Strong growth usually means more jobs, rising incomes. Negative growth means recession. Central banks watch it very closely for setting interest rate policy.
Okay, super helpful on the big picture measurement. Let's drill down into some basic financial terms people might encounter.
Good idea. Just building that vocabulary. How about amortization?
Right. That's for intangible assets like patents or goodwill, spreading the cost out over their useful life on the books.
Similar to depreciation for tangible stuff. Then, assets what a company owns. Cash, equipment, buildings.
And liabilities, what it owes.
Oh.
Debts, accounts payable.
And they link up on the balance sheet through that fundamental equation. Assets, liabilities, plus owner's equity. A snapshot in time.
Okay, capital gain.
Simple enough. When an asset you own, like a stock, goes up in value from what you paid, the opposite is a capital loss.
Cash flow statement, we covered that, tracking the ins and outs of cash.
Yep. And compound interest. This one's powerful.
Earning interest on your interest. Right. Makes savings grow faster over time.
Exponentially, yeah. But it works on debt too, so watch out.
Good point. And the income statement, or P&L?
Profit and loss. Shows revenues, subtracts expenses, gives you the net income or profit over a period, like a quarter or a year.
Okay, those terms are useful. Now, let's get really personal finance, starting with budgeting.
Absolutely fundamental. A budget is just a plan for your money. Income in, expenses out.
Tracking where it all goes. Rent, food, transport, fun.
Exactly. Mapping it out.
Yeah.
Like the example, transport $200, recreation $50, rent $800, utilities $75, health $50, food $300, savings $25, adds up to a $1,500 monthly budget.
It helps you live within your means, hopefully avoid overspending.
And actually hit your goals, whether it's saving up for something or paying down debt. You got to check it regularly, adjust it. It builds good habits.
Okay, so budgeting is the plan. Then there's saving.
Setting money aside for the future. And this is where compound interest really shines for personal
The
finance.
earlier you start, the bigger the difference it makes.
Massively. Time is your biggest ally because of compounding. Even small amounts add up significantly over decades. Different accounts compound differently. Savings accounts, CDs, investments.
Right. Finally, credit and debt. Huge topic.
Crucial. Credit is borrowing money you have to pay back, usually with interest and maybe fees.
And your credit score is key here, that number that lenders look at.
Yep, based on your credit report, which tracks your borrowing history. A good score, maybe 740 plus, gets you better loan access, lower interest rates. A bad score, say under 600, makes borrowing harder and more expensive.
What determines the score mainly?
Several things. Payment history is the biggest chunk, paying bills on time. Then credit utilization, how much of your available credit you're using. Aim to keep that low. Under 30% is often advised.
Okay, what else?
Length of credit history matters. Having older accounts open can help. How much new credit you're seeking. And the types of credit you have, like a mix of cards and loans.
So rules for managing it. Pay on time, keep balances low, don't open tons of new cards just because, keep old ones active if possible.
Those are definitely the key habits for building and maintaining good credit. Don't use credit to bridge income gaps if you can avoid it.
Okay, that's a whirlwind tour of the basics. Let's try and unpack what this all means for someone listening.
Right. Getting these fundamentals isn't just, academic. It genuinely gives you a clear view of how the financial world works, from your own budget right up to, well, global economies,
We've gone from trade-offs and opportunity costs,
to supply and demand, factors of production.
cash flow, risk, return, GDP as that big economic scorecard.
And even down to personal budgeting, saving, the power of compound interest, and managing credit scores.
So think about it. How could understanding cash flow maybe change how you handle your own monthly income and spending?
Or how might thinking about opportunity cost affect, say, your next big purchase decision? Is that new gadget really worth giving up saving for a holiday?
These aren't just abstract concepts. They're practical tools. Hopefully this gives people more confidence in navigating their financial lives.
Exactly. This deep dive was meant to lay that groundwork. Maybe something stood out as particularly surprising or relevant.
Or maybe it sparked more questions, which is great. Use this as a jumping off point. Dig deeper into what interests you.
Absolutely.
And maybe here's a final thought to chew on. We talked about how interconnected economies are. So how might a big shift in, say, the factors of production or economic policy in one major country, how could that ripple out and actually affect international trade and maybe even your personal financial situation down the line?
Yeah, something to definitely think about. The connections are everywhere.